Hello students, let us start today's session. In today's session, we are going to start studying module number 3. Now in module 3, we have to learn various decision making techniques. Now in this module, you are going to observe that they are going to be big questions, comprehensive questions they are going to be, and in which you have to take decisions within various alternatives will be available and you have to take a decision. So we are going to learn various decision making techniques. Now in this module, there are around 8 topics. Okay. Now the first topic is regarding decision involving alternative choices. Second topic is pricing decision. Third topic is transfer pricing, which is very important. Then topic 4 is related to target costing. Topic 5 is related to relevant cost analysis, again very important. Topic 6 is very easy, product life cycle costing. Then there is your topic 7 and 8, asset life cycle costing, and 8 is related to the using probability in making your decisions. So in this session, I'm going to start with topic number 3. We are going to start with topic number 3, and first we are going to learn concepts, and then we are going to solve all the questions of CMA module of the new course. So let us start with the topic transfer pricing. Now, what is transfer pricing? This concept can be understood from the fact that since in today's world, mass production is taking place in the factories, in the companies are manufacturing finished goods on mass production level. So mass production level can only be undertaken if you have technological advancement, right? Okay, technological advancement should be there. And also most important thing is decentralization. Just one department, one set of group of people cannot be delegated with all the authorities or responsibilities. Multiple departments are now set up in an organization. A company sets up various department 1, department 2, department 3, department 4, or we can call it as division also, division 1, division 2, division 3. Now if a finished good is to be manufactured, it is not just manufactured by one department. It is the finished good is manufactured in different processes. Suppose process 1 is undertaken in department 1. Then the intermediate good is transferred. See what I am saying? Transferred to department 2. Here process 2 is undertaken. Then the further intermediate good is transferred to department 3. Why am I saying intermediate good? Because it is not yet a finished good. It is an intermediate good. Then some services are provided here in department 3. After that, the good is transferred to department 4. So basically from department 3 to department 4, services plus the intermediate good is transferred. So this way the manufacturing process is delegated to various departments or divisions, correct? Okay. Now the point here is that when one department transfers to the other department, they do not transfer, they transfer at some price. They transfer the intermediate good at some price. This transfer price is not the selling price. Now the question is why department 1 is transferring the goods to department 2 at some price, which is not the selling price. Why department 2 has to pay a price? Pay a price, and that price is called transfer price. In short form, it is called TP. Why department 2 has to pay a price to department 1 when all these departments are a part of a single organization? In organization, within organization, departments have to make payment to each other. Why? The payment should come from directly from customer. When the finished good is manufactured, when it is sold to customer, then only the payment or the price should come. Customer should pay the selling price. That is fair enough. But why departments are paying to each other? That is a question. This is because one of the reason is decentralization. All departments are given proper authorities and responsibilities. They are made this word is very important. Every department or division is made a profit center. This word is very important. Now what do you mean by profit center? Every department is responsible for just not making the goods in proper cost. they are also responsible for earning profit. They are called as profit center. These every department, department 1, 2, 3, all departments are made responsible to earn profit. That is why they are called profit center. And similarly, when department 2 transfers its goods to department 3, department 2 has a responsibility to earn profit. Now, how department 2 will earn profit? When it will sell its goods. Now, it is not wrong to say it sells its goods to department 3 at transfer price. Now, in this chapter, transfer pricing, we now understand, okay, every department is responsible for earning profit. So they are called as profit center because of decentralization. Every department has lot of authority also, lot of responsibility also. So they are basically given the most important responsibility of profit earning. Now, why they are made profit centers? Because of the motivation factor they get. This is one of the reasons why every department is made a profit center. See, every worker, you, me, any worker works because we want to make money. We want to earn incentives. Now, every manager or worker works hard to earn salary, wages plus incentive. They want to earn incentive. Now, when their incentives are related to or associated with profit making, that if they make profit, they earn incentives. If more profit they make, they earn more profit. If they make more profit, they earn more incentive. Then this is a good motivational factor for them. So, we can also say it like this: transfer price. Please understand, transfer price is basically a selling price only between the departments. But we cannot call it selling price because we are not selling to ultimate customer. Transfer price is a price. You can also say it is a tool to evaluate the performance of manager. Now, manager's performance is evaluated on this basis, that how much revenue it has collected from transferring the intermediate good from its department to the other department. Okay, so we have understood the basic thing, that why transfer price comes into picture, because every department, even though it is a part of the single organization, still they transfer good at a price. Other department has to make a payment to the department 2 has to make a payment to department 1 while receiving the goods. Similarly, department 3 has to make a transfer price payment to department 2 while receiving the goods, and similarly department 4 has to make a payment to department 3, and that price is called transfer price. It cannot be called as selling price. Now, second part, what is the conflict while deciding upon what should be the transfer price? What is the conflict that the departments face when they fix up the transfer price? This is very important. See, the purpose is different. The department who is transferring the goods, this division is also called transferring division, or we can say it is a selling division because it is selling its goods. And the department who is receiving is also called buying division or receiving division or department. Okay, now they have a conflict. What is the conflict? The conflict is, obviously department 1 would like to have, when department 1 is selling goods to department 2, they would like to get the maximum revenue. They would like to they would prefer to fix high transfer price. And department 2, since department 2 is receiving goods which will be their raw material, the intermediate good will be like a raw material to them, so they would prefer to fix lower transfer price. They would like to buy, everybody wants to buy at cheaper price, so they would prefer to buy at cheaper price, and they would prefer to sell at high price. Now suppose the same intermediate good, department 1, listen to this, department 1 wants to sell this intermediate good at rupees 10 per unit, but same intermediate good is available from the market at rupees, let us say 9 rupees from market. So now this is very discouraging for department 2 to buy, to purchase from department 1. I'm discussing on this word, conflict. Okay, what is the conflict when they are fixing up a transfer price? The conflict is the department 1 wants to put up a high transfer price, and this is the this is what is asked by department 1. But department 2 is saying that I can buy the similar product from the outside market at 9 rupees. So department 2 will be discouraged to buy from department 1. And department 1 is saying that I can sell the same goods. I have a buyer. Department 1 is also adamant. He's saying I have another buyer. If you will not buy, somebody else will buy at 10 rupees because I am good at my quality. So there will be a conflict because one wants to get a good price and other is not willing to pay because he can get this same good from outside source also. Now this is not good for the company. This is a conflict. When you are putting every department as a profit center, they start fighting. There you have to mention to the managers of every department that okay, it's good to fight, but don't forget this main word, that is goal congruence. Let me put the right spelling. It's goal congruence. Congruence. Yes. Now the goal congruence here means that individual objectives are good, but they should not forget the company's objective in order to fulfill their own objective. Company's objective is to do what? To earn maximum profit and to incur the less cost, as much as minimum cost, right? So company's objective should not be forgotten in order to fulfill your own department's purpose. It's okay to earn profit, to sell at high, to buy at less, but it is not right. See, will it be right that department 1 do not sell to department 2? So department 2 should buy from department 1. Hence, transfer price is negotiated between departments. Transfer price is negotiated. What should be the price between the departments should be properly negotiated between the divisions or departments, whatever you call, and in such a way that they should not forget the company's goal congruence aim. That is, they should not forget what is the objective of their objective. Their individual department's objective should coincide with the company's objective. Otherwise, the whole purpose will be defeated. Okay. Now, this was all general talks which I just did. Now, what are we going to study in this chapter? In this chapter, we are going to learn how to fix transfer price. What are the methods? What are the methods of determining the transfer price? What should be the transfer price between the departments? So there are predominantly 4 categories you can classify into. Transfer price can be based on cost. In this also there will be further categories: actual cost, variable cost, full manufacturing cost, standard cost, total cost. Or it can be based on one more thing, it can be based on cost plus some margin. This is how you can fix up the transfer price. Or it can be based on market price. Whatever the market price is of intermediary good, the same can be kept as a transfer price also. So market price. Or it can be based on negotiation. You can negotiate what should be the price. Or it can be based on opportunity cost. So these are basically the 4 ways on which you can decide how to fix transfer price. Very simple. As the name suggests that transfer price can be based. Don't forget what is the transfer price. When department 2 buys the goods from department 1, what price it should pay? So either it can pay only the cost. So basically we are talking about only the cost. On the cost basis you can ascertain the transfer price, or you can pay whatever the market price, you pay the same price, or they can negotiate, or they can claim the opportunity cost. Now to understand all these methods, we have to go through all the practical questions. Each practical question will explain itself how the price is to be determined. You and we cannot decide. The question will tell us what the company has decided to fix a transfer price. Okay. Now let us take up a simple question which will explain us this method, that is cost plus margin method. Then each question will tell us the different methods. So it's a very basic question, question number 47. Okay, so let us start with the basic questions. Yes, please observe question number 47. Your company fixes the interdivisional transfer price. Your company fixes the interdivisional transfer price, that is when one department transfers goods to other department, the price that is fixed is called interdivisional transfer price for its product on the basis of cost plus whatever the cost that the other department has to pay plus a return on investment in the division. Okay, the budget for division A for 1981-82 appears as under. So basically whatever the cost that you have to pay plus a return on investment. Okay, what is the information given to us? Fixed assets, the division has 5 lakh, current assets 3 lakh, debtors 2 lakh. Okay, so assets list is given to us. Annual fixed cost of the division is 8 lakh. So the total annual fixed cost is 8 lakh. Variable cost per unit is given 10 rupees. Budgeted volume is 4 lakh units you are going to manufacture in a year. Desired return on investment ROI is 28% division wants to earn. Determine the transfer price for division A. So first of all, tell me how many assets the company has, the division has. Division A has 5 lakh, 3 lakh, 2 lakh. These are assets. So 10 lakh rupees of assets division A has. 8 lakh rupees is the fixed cost. Variable cost is 10 rupees. And the total units that we are going to manufacture is 4 lakh, and the return on investment that the division A wants is 28%. So let us solve this question. Very simple basic question, can be asked in your MCQs also. So this is your answer number 47. Yes. So this is your answer number 47. Now see, you are going to fix up a transfer price, how much? Cost, whatever the cost is, plus ROI, right? So let me find out transfer price, what division A wants. Division A wants transfer price how much? Whatever the cost is plus the ROI. So transfer price per unit, if I want to find out, I have to find out cost per unit plus ROI per unit. Now cost in the question is given variable cost plus fixed cost. So I need to find out both per unit, plus I need to find out the return on investment which we have to charge from the other division as transfer price. Now in the question, if you write down the workings, what is the variable cost given to us in the question? Variable cost given to us in the question per unit is rupees 10. What is the fixed cost given to us? Fixed cost given to us in the question is annually 8 lakh rupees, and annually we are going to manufacture how many units? 4 lakh units. So if I divide by 4 lakh, let me write like this. If I divide by 4 lakh, so what is the fixed cost per unit coming? Rupees 2 per unit, correct? We can create a table also, without table also you can compute, there is no harm. So variable cost, fixed cost is written here. Now this is the total cost, that is 12 rupees is your total cost. Now you have to add the ROI, return on investment that you want to charge. Return on investment, how much in return on investment you want to charge? You want to charge 28%. How much is your investment in the decision, in the division? 10 lakh rupees of assets you have, on which you want 28%. So it is coming out to be 2,80,000 you want to earn. On how many units? 4 lakh units. So per unit cost, how much it is coming? It is coming 0.70. So in total, you want to charge from the other department total transfer price. This is per unit you have to charge from the other department. Such a simple working it is. So transfer price computation can be asked in MCQs also. Such small questions can also come. So please write down the answer. It is, I already told you, it is a very simple chapter. Please write down. Pause the screen and write it down. Then we'll go on to the next question. Pause the screen and write it down. Yes, now let us move on to the next question. The next question is also based on cost. Question number 48 is also based on the fixing up the transfer price on the basis of cost. So let us see. It is again a simple question and can be asked in MCQs. It has got 5-6 parts, small parts. So let us see. Question number 48. Yes. Question number 48, please observe. Now question number 48 says, Transferor Limited has two processes, preparing and finishing. The department, the division which transfers the goods is called transferor department, and the department which receives the good is called transferee department. Okay. So the word limited is written here, but they're talking about the departments only because transfer price word will be used. Okay. So Transferors Limited has two processes, preparing and finishing. The normal output per week is 7,500 units completed at a capacity of 75%. Now, does this line hold any meaning mathematically? Yes. 7,500 units are the units they manufacture with 75% capacity. So that means they are still left with 25% capacity which is not utilized. If you compute 7,500 represents 75% capacity, so how much is 25% which is not utilized, unutilized? That is 2,500 units still can be manufactured. Okay. Further, Transferee Limited has production problems in preparing and requires 2,000 units per week of prepared material for their finishing process. So one department is able to manufacture 7,500 units per week, both preparing work and finishing work. Transferee has some problems in preparing and require 2,000 units per week of prepared material from the transfer department. So they want that the 2,000 units, only the preparing work has been done, is being transferred to transferee for their finishing process. So they want 2,000 units per week. Do we have spare capacity? Yes. How does it affect? How it will affect our transfer pricing? We will talk about it also. Going further, the existing cost structure of one prepared unit, not finished unit, prepared unit of Transfer Limited at existing capacity is material 2 rupees, labor 2 rupees, overhead 2 rupees, out of which 100% is variable. Here 50% and here 25% is variable. The sale price of completed unit of transfer, that is after doing the preparing work and the finishing work, selling price is 16 rupees with a profit of 4 rupees. Construct the effect on the profit. Now you have to construct what will be the effect on the profit of Transferor Limited for next 6 months, 25 weeks for supplying to Transferee Limited with the following alternative transfer prices per unit. Either the transfer price can be this much marginal cost. So they are basically here in this question, there are 6 ways they have said the transfer price can be fixed. Transfer price can be marginal cost plus 25%, marginal cost plus 15% on ROI, marginal cost equivalent to existing cost. So do we have to ascertain transfer price, or do we have to see how much is the effect on the profit of transferor? We have to compute the effect on the profit of transferor. So there is a lot of information in the question. The question should be with you when I'm solving it. Yes. This is your question number 48. Please observe. Now you have to understand what all information is given in the question. This is your answer number 48. The first information is there are two departments. One is transferor and the other department is who's going to receive the goods is transferee. Okay. This department performs two work on its goods and then it sells. The selling price fixed by when it sells to outside market. And it sells for rupees 16 rupees is the selling price and it makes a profit of 4 rupees. After performing two works, that is preparing work and after doing finishing work. Both works are done by the department transferor limited and then it sells for 16 rupees and profit is 4 rupees. So total cost is how much of after doing finishing work and preparing work is how much? 12 rupees. Okay, total cost. And the preparing cost of transferor only is given in the question to us, in which only the preparing cost, the first work. If it manufactures if it does preparing work on one finished good, what is the cost given to us? Material cost is given rupees 2, out of which 100% is how much is variable? 100% is variable. This is rupees 2. I'm just writing what is given in the question. I'm not solving the question currently. I'm just writing what is given. Rupees 2, 100% is variable, so rupees 2 is variable. Labor cost is given to us, rupees 2 again, and it is written 50% variable, so rupees 1 is variable. And overhead is rupees 4, 25% is variable, so rupees 1. So basically rupees 4 is the total variable cost, you can call it, or marginal cost. I hope you know marginal cost means with every additional unit when you manufacture 4 rupees is incurred. Obviously variable cost it is. So whenever you manufacture a product 4 rupees will be incurred. Marginal cost per unit, only of which work? Preparing work, not finishing work. Okay. When they have performed both the works, they sell the goods at 16 rupees to the outside market, make a profit of 4 rupees. So to them total cost is 12 rupees. Okay. So this we have computed. Now transfer currently how much it is manufacturing? Transfer is currently manufacturing how much? After performing preparing and finishing work both, 7500 units, which represents 75% capacity. So unutilized capacity is how much? 2500 units. Correct? Why? 7500 represents 75% capacity. So 25% capacity which is not used is 2500 units. So that means transferor can manufacture 2500 units more and transfer it to transferee company without affecting its sale to outside market. It is currently manufacturing and selling to outside market at how much? 7500 units. So see, this is very important. This is a basic question. So in the basic question, you are not going to disturb your outside sale. Outside sale will continue. You are not going to lose any sale to outside market. Rather, you will manufacture that will continue. You still have spare capacity of 2500 units and transferee company limited only needs 2000 units per week. And we are talking about 25 weeks. So basically total will be how much units we have to supply? 50,000 units have to be supplied. Now, since we have spare capacity, we have nothing to lose. So there's no opportunity cost. Opportunity cost is that we are not losing any opportunity of earning. We are sitting idle. We can easily manufacture 2500 units. Transferee wants us to perform only the preparing work, not the finishing work. Finishing work they will do themselves. So they just want that we should perform the preparing work and transfer 2000 units to transferee company. We can do it. We have nothing to lose. We are not going to lose any revenue. If we are going to lose any revenue, if we have to supply to the transferee for example, if we have to supply to transferee limited and we suppose we do not have spare capacity, so we have to stop this outside sale. So we might lose some revenue. So that will be our opportunity cost. Then we have to charge that opportunity cost from the transferee. But in this current basic example, there is no such issue. in the future questions there will be such issues, okay, that you are losing some opportunity because you are transferring to your other department. Okay, currently there is no such issue. We have spare capacity. We have what capacity? We have spare capacity. We can easily, so this is question is related to spare capacity. Don't forget spare capacity. So you can write here, no opportunity cost is there. We are not missing any opportunity here. Okay. So no opportunity cost will be added to transfer pricing. Now the question is saying, when you transfer this to Transferee Company Limited after performing the preparing work, how much profit is affected of Transfer Limited if first case says the transfer price is fixed equal to marginal cost. Now marginal cost means variable cost, correct? So if you will have to supply 50,000 units to Transferee, and if you fix the variable cost 4 rupees as transfer price, you charge them 4 rupees, there is no profit to them, neither loss, because currently you are not even selling those 2500 spare capacity. You already have spare capacity, so let me write like this. That means transfer price will be equal to rupees 4, which is equal to variable cost. So whatever you are going to incur in manufacturing, same will be recovered. You are going to incur 4 rupees in manufacturing, and same will be recovered from Transferee because they are going to pay you 4 rupees. So there will be no profit, no loss, because no effect on profit of transferor. Why? Because you are paying to them that much what they are going to incur in order to supply to you this 50,000 units. So when 50,000 units will be supplied at rupees 4 per unit, so only cost is recovered, no gain is there, so no effect on profit. And let me also tell you, let me also compute for you how much is the current profit of transferor. Transferor is currently selling in outside market 7,500 units per week. So in 25 weeks it sells this much units, and every unit it is making up 4 rupees of profit. So currently the profit is 7,500 into 25 into 4. So currently the profit is of 7,50,000. That profit will not be affected. That profit will not be affected because you are not making any money from the Transferee Limited. So my dear students, please pinpoint these points. First, you are manufacturing from the spare capacity to supply to Transferee Limited 2,000 units per week. You have 2,500 units spare capacity per week you have. So you can easily supply. You do not have to disturb your outside market sale. That will not be affected. You will be still earning 7,50,000 rupees profit from the outside market. Yes, from Transferee Limited you are not going to earn anything because you are selling them at 4 rupees, which is your variable cost. So there will be no effect on the profit of Transferee Limited. It will still continue to earn 7,50,000 from outside market. Okay. Now going back to question and see what is the second part. Second part says alternate transfer price per unit to be marginal cost plus 25%. Okay, now the profit is coming, contribution is coming into picture. Okay, so now what will be the transfer price? In the second case, the transfer price is equal to, I told you question will itself tell you what should be the transfer price, plus 25%. So rupees 4 plus 25% of 4. So rupees 4 plus 1, rupees 5 will be transfer price. Now this is your transfer price. So what is the profit? Obviously profit is how much transfer price minus marginal cost. When you transfer to the Transferee Limited, you are charging them 5 rupees and your cost is 4 rupees. So you are making 1 rupee profit. And on how many? So profit will increase by how much? 50,000 units you are supplying to them in 25 weeks, and on every unit you are making 1 rupee profit. So 50,000 rupees is your profit that you will make on if transfer price is equal to marginal cost plus 25%. Third case. What is third case? How much should be the transfer price? Simple question it is, okay. How much is the transfer price? Let us go and check. Yes, the transfer price is, in the question given, marginal cost plus 15% return on capital. Assume capital employed to be 20 lakh. Now there is a issue in the solution. They have assumed this 20 lakh to be the capital of the company, and company has two departments, transferor and transferee. So that means and we assume here, first of all let me write, you have understood what is the transfer price? Marginal cost plus 15% on the return on the investment, and investment is 20 lakh, capital is 20 lakh. Okay, going back to question solution. In the question they have assumed marginal cost plus 15% on capital employed. This should be transfer price, right? Now in the question they have assumed organization capital to be they have assumed this thing in the solution. You can assume otherwise also. Organization capital to be 20 lakh. So we assume that transferors capital is 50% of the same. This we are assuming. Otherwise, other way also you can assume that this whole capital belongs to the transferor only. Okay. So how much do you want to? How much transfer price you have to keep? Marginal cost, which is rupees 4, plus 15% on capital employed. So 15% on capital employed. So how much will you charge here? See, 15% on capital employed, 15% on 20 lakh into 0.5, because the capital employed is 50% only, divide by how many units. This is the return you want to charge on how many units you are going to supply to the transferee, 50,000 units. So per unit how much return you are going to charge? 20 lakh into 15% into 0.5 divided by 50,000. So this comes out to be rupees 3. So transfer price is going to be rupees 7. I hope you are understanding what question has assumed. Question has assumed, my dear students, question has assumed here that the total, you can assume otherwise also. Question has assumed that organization has 20 lakh of capital, of which 50% belongs to transferor. This is assumption. You can assume that the whole capital belongs to transferor only. Then you don't have to multiply here with 0.5. Okay. But I am matching up my answer with the solution given in the CMA module. So I have taken here 0.5. So 20 lakh is the capital employed. In the transferor company, capital is only 50%, 10 lakh. On 10 lakh of capital, the return we want 15%. So return is coming out to be 3 lakh. That 3 lakh return you have to earn on 50,000 units, because you're going to transfer that to transferee. So 3 rupees, that means transfer price is 7 rupees. Now how much will be the effect on profit? Anything we get beyond 4 rupees is our profit. So we are getting 3 rupees additional. So profit will increase by rupees 3 into 50,000 units. So rupees 1,50,000. Correct? Yes. Please observe the next part. Fourth part. Now the transfer price has to be equal to the existing cost. What is the existing cost? When you are doing just preparing work, because you have to do only preparing work and transfer it to Transferee Limited, what is the cost that you have to incur? The existing cost, not just the variable cost, the existing cost, total cost. 2, 2, 4 and 4 plus 4, 8. So 8 rupees is your existing cost, which includes variable and fixed, both portions. So let us write this thing. Yes. So in this case you are going to take what? This is your which part? Just a second. This is your fourth part, right? Yes. So fourth part, transfer price is equal to existing cost. Existing cost we know is how much? Rupees 8. Anything which you get more than 4 rupees, because that is your cost of marginal cost, variable cost to manufacture a good. Anything you get more than 4 rupees, that is your profit, because already you are not affecting your outside sale. So how much profit will be affected? Profit will increase if you charge 8 rupees per unit from Transfree Limited. So profit will increase by rupees 4 into 50,000 units, that is 2 lakh rupees. Your profit is going to increase. Now let us solve the next part, that is your fifth part. So basically question is going to tell us how much transfer price we have to keep. Going back to question. Yes. So question says how much transfer price? Existing cost, whatever the existing cost is, plus a portion of profit on basis of this. So whatever the existing cost that you charge from Transfree Limited, plus some portion you have to charge of profit, like this. Whatever the preparing cost is divided by total cost into unit profit. So okay, let me write this. Going back, they are going to tell you directly what should be the transfer price. So let me write on the next page, fifth part, transfer price. Just a second. Yes. Transfer price. How much should be the transfer price? Question is telling us transfer price should be existing cost plus add a portion of profit. How much we should add to it? They have given you a proportion, preparing cost divided by total cost into unit profit. So existing cost is rupees 8 plus preparing cost divided by total cost. Total cost is 12 rupees and preparing cost is 8 rupees. Ma'am, where have you got this information? Very simple. Going back, when we have written the whole information, here I have written the preparing cost is 8 rupees, total cost 8 rupees, and when you are after performing preparing and finishing work, you are selling it for 16 rupees, profit is 4 rupees, so total cost is 12 rupees. This cost includes preparing cost and finishing. Preparing cost is only 8 rupees, but total cost is 12 rupees and profit per unit is 4 rupees. Okay, so putting up the same figures, and profit per unit is 4 rupees. So how much do you get? Rupees 8. How much do you get? 8 into 4 divided by 12. So it is 2.666. plus 8. So you get 10.67. This is your transfer price. Now we have to compute only transfer price or compute profit, effect on profit. So how much will be the effect on profit? Whatever you receive from the transferee beyond 4 rupees, that is your profit. So here the effect on profit will be how much? Effect on profit. Anything you receive beyond 4 rupees is your profit. So how much is the profit? Minus 4 rupees if I do, it is coming out to be rupees 6.67. So if a profit will increase by rupees 6.67 into 50,000 units, 6.67 into 50,000 units, so you get profit will increase by 3,33,500 rupees. So this will be the effect on profit. Simple English, you just have to read the English and interpret it mathematically. Now let us go back to question again. There are many parts to it. Yes, so we have done the fifth part. The sixth part is very simple. You have to keep a transfer price how much? At an agreed market price of 8.50. Assume no increase in fixed cost. So they have negotiated that the market price, whatever the market price of preparing portion only is 8.5. So transfer price is 8.5. Simple, straight answer is it has, this is 6th part. So transfer price is 8.50. Anything which you receive beyond 4 rupees is going to increase your profit, because that is your contribution. So how much is your increase in profit, effect on profit? Rupees 8.50 minus 4 is rupees 4.50. So profit will increase by rupees 4.50 into 50,000. So this come out to 2,25,000. Yes. So this was a basic question. 2,25,000 the profit will increase, and it has no complication as such. Just have to read how much should be transfer price. What you have to learn in this whole question is that our outside sale was not affected. We had a spare capacity. So anything what we get beyond variable cost is going to increase our profit. This much you have to memorize. Now the questions will come up where we have to disturb our outside sale, which is going to affect our profit opportunity, and that will be charged from the transferee company. So please write down the answer. Pause the screen and write it down. I am putting up the first page. Yes, this was the explanation I was giving you, what information is all given. You can write it down. Pause the screen and write it down. Pause the screen and write it down, please. I'm changing the sheet. Pause the screen and write it down. I'm changing the sheet. Pause the screen and write it down. I'm changing the sheet. Pause the screen and write it down. Pause the screen and write it down. Yes, please observe the next question, question number 49. Again, a basic question. We don't have to go into depth of transfer pricing. In this question, we have nothing to do with determination of transfer pricing or fixation of transfer pricing. We just have to read the question, and from the question figures we have to just compute the profitability. Okay, so and the profitability of each division. So this question is related to profitability of each division. Okay, so let us read this question. Again, a basic question. A company with two manufacturing divisions. So a company has two divisions, two departments, is organized on profit center basis. This profit center basis should give a alarm in your mind that this question is related to transfer pricing. Okay, so a company has two departments. Division A is the only source for supply of a component that is used in division B in manufacture of the product KLIM. So department A manufactures a product which is used by department B as a raw material in manufacturing of the finished goods KLIM. One such part is used in each unit of product KLIM. As the demand for the product is not steady, demand of the finished goods is not steady. What is the finished good? KLIM. Division B can obtain orders for increased quantities only by spending more on sales promotion and reducing selling price. So they are saying that department B can only sell more of KLIM product when it reduces selling price and increase the cost on promotion. Okay. So the manager of division B has accordingly prepared the following forecast of sales quantity and selling price. So sales units per day average. Averagely every day 1000 units if you want to sell. Selling price per unit of KLIM has to be fixed 5.25. If you want to sell 2000, this is a selling price. 3000, this is a selling price per unit. Whatever quantity you want to sell, this is a selling price. You keep on reducing selling price per unit, quantity of sales per unit will per day will increase. Okay. So this is a sale of which product? KLIM, which is manufactured by division B. Division B uses a raw material which is manufactured by division A. Now the manufacturing cost of KLIM in division B is 3750 for first 1000 units. So for first 1000 units, the cost to manufacture KLIM in division B is 3750 and rupees 750 per 1000 units in excess of 1000 units. So 1000 units you manufacture more, you have to incur 750 rupees more. You manufacture 1000 additional, you have to incur additional 750 rupees. Okay. So that means for every 1000 additional units, you have to incur additional 750 rupees. See, you can read again. The manufacturing cost of KLIM in division B is 3750 for first 1000 units and rupees 750 per 1000 units in excess of 1000 units. Division A incurs a total cost of, now we are talking about division A. Earlier we were talking about division B. Division B story is finished. Now we are coming to division A, who manufactures the raw material. Division A incurs a total cost of 1500 per day for an output to 1000 components, and total cost will increase by 900 per day for every additional 1000 components manufactured. Okay. So division A, which manufactures a component, the manufacturing cost of component is 1500 per day for output of 1000 components. But if you want to manufacture 1000 more than 1000, for every next 1900 rupees will have to be incurred. So let me read again. Similar story, they're just trying to tell you the cost. In the beginning of the page, they told you KLIM finished goods selling price. Then they told you what is the cost to manufacture KLIM finished goods in division B, and the cost will increase by 750 for additional 1000 units. Then they are now telling you the division A component which is manufactured, what is the cost? 1500 for the first 1000 units, then it will increase by 900 for every additional 1000 components. The manager of division A states that the operating result of division will be optimized if the transfer price of the component is set to be 1.20 per unit. So they have told you the transfer price at which division A will transfer the goods to division B is set to be 1.20. You don't have to compute anything. And he accordingly set a foreset transfer price for his supplies of components to division A. Then prepare. Now what do we have to prepare? Prepare a schedule showing the profitability at each levels of output for division A and B. So separately you have to show the profitability for division A and for division B separately profitability. How is profit computed? Very simple. Revenue minus cost is equal to profit. Okay. Now we have to compute profit at what quantity? At the each level of output. What is the each level of output? This is the 1000 units, 2000 units, 3000. What is the profitability? If in a day you manufacture 1000, if in a day you manufacture 2000, 3000, these are the different levels. So what is the profitability? So let us first find out this part and then we will discuss the second part. Okay. So let us go and solve this first part. Yes. So what do you have to do? This is your answer number 49, correct? Now, first of all, I am going to prepare a statement showing profitability of the first division, that is division A. Statement showing profitability of division A. First I am going to start with the profitability of division A at different sales levels. Now let me prepare the chart first. What are the different sales level? Sales quantity I'll write here, then I will write the sales revenue which is mentioned. Let us see what is sales revenue we are going to use, then cost, and then the profit. Now please answer me first question. Division A manufactures directly KLIM or the component? It manufactures component. Does it sell its component to outside market? No ma'am, it transfers its component to division B. At what transfer price it is charging? The transfer price it is charging is rupees 1.2 per unit. It is given in the question. So division A's selling price, or I would say transfer price or selling price, is the same because division A's manufactured goods are transferred to division B. Now what is the quantity that we have to use? In the question, if you see in the question, yes, in the question if you observe, whatever the KLIM will be sold, accordingly component will also be purchased from division A. Now KLIM can be sold for sold 1000 units, 2000 units, 3000 units. This is the selling price of KLIM. I don't want this. I just want to know the how much quantity of KLIM will be sold in the market, finished goods. Accordingly the component will be manufactured by division A. So 1000, 2000, 3000, 4000, 5000, 6000, and plus also see the cost. Cost is 1500 rupees per day on 1000 units, and if you manufacture more than 1000 units, 900 rupees cost will increase for every additional 1000 units. So similarly I will use this information here. Very simple calculation it is. So please observe. Yes, so what is my sales per day? It can be either 1000, or it can be 2000, or it can be 3000, 4000, 5000 and 6000. What is my sales value or transfer price value? I know every unit is going to be sold transferred for 1.2, so I multiply with 1.2, I am getting 1200. 2000 into 1.2, I am getting 2400. Then this is going to be 3600, 4800, then 12 5 is 6000, then 7200, right? So I have got the sales revenue. Now what is the cost? Cost they have told that on every 1000 units the cost is 1500, and if the units manufactured per day increases, see, either you manufacture 1000 units, cost is 1500. If you manufacture in a day 2000, beyond 1000 you manufacture, cost will increase. Every 1000 the cost will increase by 900. So the cost will be how much? 2400. If in a day you manufacture 3000 units, then on every additional 1000 units, 900 rupees cost will be charged again, will be increasing. So 3300 cost, right? Then if you manufacture 4000 units, so every 1000 increase, if in a day you manufacture 4000 units, 1500 is the cost per 1000 units. Then for every additional 1000 units you have to incur 900 rupees. So again the cost will increase by 900. And similar way it is going to be 3300, 4200, then 4200 plus 900 is 5100, and then 6000, this way. So we have computed the cost. Now we can easily compute the profit or the loss, whatever the case is. So 1200 is your sales revenue and your cost is 1500, so you are incurring a loss of 300 here. Here there is no profit or loss because 2400 is the revenue and 2400 is the cost. 3600 minus 3300, so profit is 300 here. In this case 4800, 4200 minus 600 is the profit. Then your 900 is the profit and 1200 is your profit. This is the profitability of division A. Now it is very important to observe for division B. Because division B incurs two types of cost. One, that it purchases the component from division A. Then it incurs its own cost also in manufacturing of KLIM, and then it sells. So let me write here sales per day. What can be the output level? It can be 1000 sales quantity, 2000, 3000, 4000, 5000 and 6000. Okay, now what is the revenue, sales revenue? Let us write. So it is given in the question. If you see in the question, it is given in the question the selling price per unit. See, KLIM selling price is given to you 5.25, 3.98 per unit. So you multiply with this. So here you get 5250. Here you 3.98 multiplied with 2000, 3.30 multiplied with 3000, 2.78 multiplied with 4000, and similarly. So I'm writing the same here as sales revenue. Yes. So sales revenue is how much? So if you multiply, we get 5250. Here we get 7960, 9900, 11, 12,000 and 12,060. Now we have to write the cost. Now there are two types of cost. One is your transfer cost, that is the component that you have purchased from the division A. Now division A has given you whatever is the revenue of division A, that is your cost, because you have only paid that revenue. So the revenue of division A is your transfer cost. So this is the cost: 1200, 2400, 3600, 4800, 6000, 7200. Ma'am, this is the cost. This is the cost for division A. Division A has sold you this component at this price. You have paid this price. So this is your cost now. And you yourself have incurred cost. You yourself have incurred cost. Please observe in the question. Division B, manufacturing of KLIM in division B is rupees how much cost? Manufacturing cost 3750 for the first 1000 units. Then this cost keeps on increasing, 750 per 1000 units, excess of 1000 units. So let me incorporate this thing. Yes. So other manufacturing cost, it is 3750 for first 1000, then it will increase by 750. So it will become 4500, then it will become 5250, then it will become 6000 for every 1000 increase. Now you can write the total cost here, which is 4950. I'm adding up and these two figures. Total cost. So 6900, 8850, 10,800, 12,750 and 14,700. And how much is the profit or loss? Please observe profit or loss. It is in the first case 5250 minus 4950, so you get 300. Second case 7960 revenue minus 6900, this is 6900, so you get 1060, then 1050, then 320, and then there is a loss of 750, and then there is a loss of 2640. I hope it is visible to you. So this is the profitability of division B. Clear? So what have you learned out of this? Just that whatever the cost is involved in division A, whatever is the revenue of division A, that is the cost of division B, because division B is only purchasing from division A, plus it is incurring its own cost also. Now let us go back to question and see what is asked in this B part of the question. Now the B part of the question is, find the profitability of a company as a whole at output levels, which division A's net profit is maximum and division B's net profit is maximum. Let me repeat again. Find the profitability of a company as a whole. How much company as a whole is earning? Because these two departments belongs to company only. At what output level? Should I find out the profitability of the company at 1000 units, 2000 units, 3000 units? So it is saying find the profitability of the company as a whole at the output level, where first part, where division A's net profit is maximum, then find out. So let us see when is department A's profit maximum, then let us see what is the company's profit as a whole, then also see when with the output level where division B's net profit is maximum. So let us see, observe in our solution. Yes. Now please observe, division A is making highest profit when? At 6,000 units, right? So let us find out how much is the profit of a company as a whole or at 6,000 units. So let me write like this. Yes. So let us write profitability of the company as a whole. Profitability of company is nothing. Whatever the profit of division A and B together is the profit of company as a whole. So profitability of the company at output level where division A's profit is maximum. Now division A's profit is maximum where? At what output level? Output level 6,000, right? Now output level 6,000 units. What is the profit of division A at 6,000 units? And we have to also write the profit of division B at 6,000 units. Then only we can find out the profit of a company as a whole. Correct? So we are just finding out the profit at 6,000 units because that is the profit where division A is earning maximum. So let us see in our observation. At 6,000 department A is making 1,200 and department 2 at 6,000 is making 2,640 loss. Okay. So let us write the same thing. 1,200 profit and 2,640 loss. So in total company is making a loss at 6,000 units. Similarly, again we have to compute profitability. This was the second part first. Now profitability of company at output level where division, here it was A, here it is now B. Division B profit is maximum. Now let us observe when is division B making highest profit. Division B is making highest profit where? 1060, right? That is at 2,000 units, correct? So let us find out at 2,000 units both division A and B is making how much profit. So let me write here. Output level 2,000 units. So let us find out the profitability of company as a whole at 2,000 units. So profit of both divisions will only make the profit of the company. So profit of division A at 2,000 units. Similarly, we have to write the profit of division B at 2,000 units, and then we have to write the total profit of the company. So how much is the profit? Let us see. At 2,000 units, the division A is not making any profit and division B is making 1060 profit, right? So nil here and 1060 profit. So 1060 is the profit. This is the solution to your second part of the question. Now let us go and see the third part. See, I have not explained you any technical part of the transfer pricing. Why? Because these are the just basic question. You just have to read and solve it. The technical part is yet to come of transfer pricing. When we have to learn how to determine transfer pricing, how to determine what should be the transfer pricing. But that question has not yet come. Okay. Please see the third part. If company is not organized as profit center basis, okay, so company is not profit center, nobody has to earn any profit, what level of output will be chosen to yield the maximum profit? Obviously, if independent departments are not profit center, so what level of output should we sell? Obviously, we will sell that level of output where the company as a whole is making highest profit, right? So what we are going to do, we are being asked what level we should sell if individual interest is not to be seen. Individual departments interest is not to be seen. See, individual interest, if we see, then department A would always like to sell at 6,000 units. Department B would always love to sell at 2,000 units because it is making maximum profit. But now the question is asking, if suppose we do not have to look for the interest of independent departments, we have to look for the interest of company as a whole, then what level of output we should sell? So let us do one thing. Let us find out the profit of company as a whole at all the levels. And then the level at which company is making the highest profit, that level of output should the company manufacture. So I'm going to prepare a statement. The third statement I'm going to prepare, third part. Let me find out profitability of company as a whole. I have to just do what? I just have to write here sales levels. Then I am going to write here the division A's profit, division B's profit and total profit. Okay. So division A profit, division B profit, and at different sales levels. And then we are going to add this up and find out total profit, total company's profit. Correct? So let us write out the division levels. 1,000 sale can be take place, 2,000, 3,000, 4,000, 5,000 and 6,000. Now I'm just going to pick up the figures from here. What figures I'm going to pick up? The profit of division A at different levels, profit of division B at different levels, and going to add this up. Okay. So yes. So I'm going to write the same. Division A's profit, here it is loss, here it is nil, here it is 300 profit, then 600 profit, 900 profit and 1200 profit. Here it is 300 profit, 1060, 1050, 320 and 750 loss and 2640 loss. If I add these two, this becomes nil, this becomes 1060 profit, 1350 profit. I'm adding up these figures, okay? And 920, 150, and here the loss gets reduced to 1440. Now please tell me where the profit is the highest. At what level the profit is highest? Yes. So profit is highest at what level? You can observe at 1060, that is at 1350. So 1350 is the highest profit company can make at 3000 units. So best output level is 3000 units, right? So the question is now solved, but as a student you must have some queries, and one question which comes up to students' mind is, when you are computing company's profit, company will make profit only when, see, I'll tell you. This should be the question in your mind, okay? What should be the question in your mind? That, ma'am, company's profit will come only when we sell the goods to final ultimate customer. Suppose the goods, the cost of good is 18 rupees and we sell it for 22 rupees to the ultimate customer. Then this 4 rupees is the profit of the company. But inter-department profits, the goods are transferred here at this price, then it is finally sold to customer. Inter-department profit is not the profit of the company because we are not really selling to the customer. Yes, you are right. Inter-department profit is not the profit of the company because we are not, see, in the company you sell, you manufacture it for 4 rupees, you transfer it for 6 rupees to the other department. Company is not making any money. It is only just for writing purpose. But the profit will still come 4 rupees only. I'll show you. Suppose this is 18 rupees cost. Correct? So let me write it on next page. See, what happens is, whatever is the profit of department 1, it becomes the cost of department 2, so it gets cancelled out. So ultimately the profit will come the same for the company. Okay, I'll show you. Department 1, suppose it manufactures something for rupees 2 and transfers it for rupees 3. Department 2 for rupees 3. So it accounts for how much profit? It is saying I have earned how much profit? 1 rupees profit, right? Now this transfer price becomes the transfer cost to department 2. Department 2 does further cost on it. Let us say rupees 2 rupees, all it incurs more other manufacturing cost. So now its cost becomes rupees 5, and let us say it sells for rupees 8. Selling price is rupees 8. So it says that I have manufactured the goods for 5 rupees and I have sold for 8 rupees. So department 2 says my profit is 3 rupees. And department 1 says my profit is 1 rupees. And I am saying company's profit is department 1's profit plus department 2's profit. Department 1's profit is rupees 1 and department 2's profit is rupees 3. So basically I am saying company's profit is 4 rupees. Now forget about department's profit. Let us find out company's profit in a simple word, simple language: selling price minus cost, actual cost incurred. Now how much department 2 has incurred? Rupees 2 is the cost. And how much department 2 has incurred from its own pocket? Only 2 rupees. And it has sold for 8 rupees. So 8 rupees is the final selling price. And cost incurred by both departments, their own cost incurred is 4 rupees. So basically it is coming, again the profit is coming 4 rupees. Here also profit is coming 4 rupees. Why the same profit? Because here whatever department 1 is showing its profit, that profit department 2 is showing 3 rupees profit, because its profit gets reduced, because whatever the department 1's profit is, it becomes the cost of department 2. So it automatically cancels out. Inter-department profits gets cancelled out like this. Ultimately you are reducing the total cost from the selling price and the profit is shown here. So same profit will come. If you add department's profit, still company's profit will come. Okay, so inter-department profits gets cancelled out like this. One department's profit is the transferred cost for other department. I hope you have understood this. And when their cost increases, their profit is shown less. So here profit gets reduced. So 3 plus 1, 4. Otherwise, as a company, if you see, both departments have incurred 2 rupees here and 2 rupees here, 4 rupees and 8 rupees was selling price. So this is how it is cancelled out. Anyways, coming back. So we have done this question. Please write it down. I'm enlarging the screen. The first screen is this. Please pause the screen and write it down. Pause the screen and write it down, please. I'm changing the sheet. Please pause the screen. Pause the screen and write it down. I'm changing the sheet. Please pause the screen and write it down. Yes. Yes. So we have started learning about transfer pricing. Only two things you have to memorize after this lecture is that if you are transferring goods to the other department and your outside sale is not affected, then if you even get variable cost, then it is good enough. Anything beyond variable cost, if you get, that is your profit of that department. First. Second thing, the department which is transferring goods is called transferor department, and the department which is receiving goods is called transferee department. Both departments profit will be equivalent to organization's profit. Okay, and we have not yet learned anything about fixation of transfer pricing, except in question number 48 we have learned to fix transfer pricing on the basis of cost, which question will tell us, and we will just put it accordingly. But there are a lot of concepts that we have to learn regarding fixation of transfer pricing. As questions will come up, I will teach you, and after doing 5-6 questions, then I will make you write down some notes and cases where we have to see what transfer pricing has to be determined, how it is to be determined. Okay, so you have to wait till 5 to 6 questions, then we will write down the summary that how transfer price. If I will make you write down now, you will not be able to understand anything. What is incremental cost, what is opportunity cost in transfer pricing. We have to go question wise question. Okay, and then after 5-6 question, I will write it down, make you write down the whole summary of it. Okay, so this much for this session, and in the next session we will continue further doing transfer pricing. So thank you and have a nice day.